You can't ignore it. It's certainly but the Middle East has always been a hotspot that people have been worried about and factoring into their estimates. So I don't think it's necessarily a major thing to rein in risk. You were talking about May 12th was the last attacks or reported attacks, and oil's down 20% since then. So you just have to take it into account, see do we see another round of maybe attacks in a couple of weeks, then it becomes a trend. But it's just too early.
How about this? Protests in Hong Kong yesterday and today. Now this. Attacks a month ago. The VIX at 15.
Yeah, I mean...
Does that make sense to you?
I think you just have to look at the overall market, and the VIX is just a reflection of what the market's been doing, and the market has been relatively calm here. We had a sell-off and we've rebounded very strongly. So I think you just have to look at the whole broad market impact, broad market landscape, and it's certainly a very confusing time for investors here because we have, the Fed and trade, which I think are two issues, obviously, that are much more front and center than what's going on in the Middle East right now.
I love you guys. You do this as your name.
We love you too.
Thank you. It's a love. Bespoke, obviously, you guys do customized research and put out these cool things. And one of the things you posted last night was dividend yields. We talk about how when bond yields come down and dividend yields or whatever, people might migrate to stocks because they think, well, I'd rather get the capital appreciation if the dividend yield's going to be about the same as the market. But what I didn't realize until you posted it last night is the United States' dividend yield is actually pretty meager, 1.98%, second lowest in the world behind India. Why do you think there's still so much interest in U.S. stocks?
Well, dividend yields are one thing, and what you have to take into account is the tax treatment of dividends. So that's one reason you have the yield so low. And if you add in buybacks...
Because we tax them less.
Well, dividend, as an investor, dividends used to be treated much more, it was much better for an investor to have a company buy back stock because you don't take the tax hit than it is for a dividend. And so you add in the buyback yield and you're closer to 4%. So what you're looking at is, and you have to compare it to like you said, interest rates with the 10 years yielding about 2%. So when you have a pretty similar yield on dividends and the 10-year, for the U.S. at least over the past decade or more, it's been generally a good time for U.S. equities.
Yeah, put that chart back up because all the way at the left side of the screen is Germany. 3.3% dividend yield. We're at 1.9. By the way, the German market, very quietly, is up 14% this year. Are there better opportunities outside of America than inside of America?
So we think U.S. equities are still attractive, but you're right. There are other areas of the world that are attractive. I think emerging markets is an asset class that has just been left for dead. It's been, on a relative basis, it's back to where we were over 20 years ago versus the U.S. So you see no outperformance on that. So I think investors could look overseas. If the dollar's been very strong, if we start to see the dollar weaken here, that's only going to be good for emerging markets.
Do you think it will weaken?
Will what?
The dollar.
I think we've seen some very big strength, but if we start to see easing on trade, that's going to be negative for the dollar.